For more than 2 decades, a powerful assumption has anchored the global economic system. It was a belief held with near-unanimous conviction in boardrooms, finance ministries, and academic circles, from New York to Shanghai. This core idea was that the deep financial and commercial interdependence between China and the United States formed a kind of unbreakable guarantee. It was thought to ensure stability, discourage any serious confrontation, and protect global markets. The logic seemed simple and self-reinforcing. When two giants are so thoroughly intertwined, the cost of separation becomes too high for either side to bear. This mutual reliance was seen as the global economy's primary shock absorber. That long-held assumption is now being fundamentally tested. Foundations once solid as bedrock are showing signs of strain. Since about 2021 and accelerating to the present, China has been methodically executing a large-scale, coordinated economic repositioning. This is not random market noise. It is a deliberate strategy unfolding across multiple fronts. Calculated shifts in foreign exchange reserves, changes in sovereign and institutional investment portfolios, and efforts to build alternative trade settlement systems. Securing commodity supply chains and rethinking the infrastructure of cross-border payments. Aggregated moves show assets being reduced, reallocated, or prepared for potential exit in the trillions. A common, credible estimate, up to $8 trillion. These assets span a vast network of state-linked institutions, sovereign wealth funds, major state-owned banks, large enterprises, and influential policy banks. A financial migration of historic proportions. Not with a bang, but the quiet hum of a colossal machine being recalibrated piece by piece. This is not a single impulsive decision in a moment of crisis. Not a short-term reaction to sanctions, tariffs, or inflammatory headlines. Instead, a sequenced strategic shift across a multi-year timeline. And as history shows, when such sequences emerge between a rising power and an incumbent system, markets don't collapse overnight. They enter a new, challenging era of structural stress. This period of structural stress is characterized by a distinct set of symptoms. We see heightened volatility that becomes the new normal, not an exception. We witness the fragmentation of once unified global systems into parallel or competing blocks. A fundamental repricing of risk occurs as long-held assumptions about safety and return are questioned and discarded. And most importantly, we observe long-term, durable shifts in the direction of global capital flows. These outcomes are not driven primarily by ideology, political rhetoric, or the passions of the moment. They are the logical consequence of a simple, powerful mechanism that has repeated throughout economic history. When dependencies become too concentrated in one direction, they inevitably transform into leverage. This analysis is designed to accomplish 4 specific goals, moving from verifiable facts to historical context, and finally, to a realistic assessment of the future. First, it will identify what has tangibly changed since 2021. Asset holdings, trade settlement, reserve composition. Second, it will explain how similar sequences of economic power transition have unfolded in the past, step by step. Third, it will assess where the current risks realistically sit, avoiding the extremes of alarmism and complacency. Finally, it will clarify why the window between 2024 and 2027 is so critical, not as a doomsday clock counting down to collapse, but as a crucial stress testing period for the global financial architecture. This is an exercise in structural risk analysis, not an attempt at fear-mongering. The most profound shifts are often those that occur beneath the surface, far from the noise of daily commentary. The core of our investigation will be a 4-stage sequence that has historically defined economic power transitions. Stage 1 is deep interdependence, where risk is mispriced as non-existent. Stage 2 is asymmetric accumulation, where one power builds leverage quietly. Stage 3 is strategic repositioning, where the accumulating power diversifies away from its dependencies. Stage 4 is systemic stress or fragmentation, where a shock finally forces a market repricing. By understanding this sequence, we can better contextualize China's $8 trillion move and recognize it for what it is: a pivotal development in the unfolding economic story of the 21st century. Across the long arc of modern history, the transfer of economic dominance from one power to another is not a chaotic or unpredictable event. It follows a recurring structure, a predictable sequence of events that unfolds in plain sight, yet is often only understood in retrospect. The specific nations involved may change. The financial instruments evolve with technology, gold bars to digital currencies, but the underlying logic remains remarkably consistent. This sequence can be broken down into 4 distinct stages. The first stage is deep interdependence. This is a period of intense economic integration where trade binds 2 major economies together. Capital flows bind them. Shared supply chains bind them. The prevailing wisdom is that entanglement makes conflict irrational, impossible. In reality, systemic risk is profoundly mispriced, creating a hidden vulnerability beneath prosperous stability. Following interdependence comes asymmetric accumulation. The rising power accumulates strategic assets. It builds production capacity. It gains financial leverage. The incumbent deepens dependence by running trade deficits and relying on capital inflows to finance consumption and government spending. Power shifts through the slow, invisible mechanics of unbalanced exchange. The third stage, strategic repositioning, directly describing China's current actions. Having accumulated leverage, the rising power reduces vulnerabilities. It de-risks its position while keeping a cooperative outward appearance. Actions include diversifying reserve assets, building alternative payment systems, securing long-term access to energy and food, and forming parallel economic blocks. The final stage is systemic stress or fragmentation. A shock forces a repricing. Markets don't implode instantly. Volatility, fragmentation, and selective repricing dominate. At this point, China and other advanced economies cut risk exposure and sold U.S. Treasuries, reducing dependence and redirecting capital. This is where wealth transfers occur. Final takeaways. Interdependence does not equal immunity. Repositioning precedes stress. Quietly, the $8 trillion shift is about vulnerability reduction, not headlines. Reserve dominance erodes at the margin. Sequences matter more than predictions. If you want clear, independent analysis grounded in history, data, and real market mechanics, subscribe for long-form geopolitical and financial breakdowns. Share this with someone who believes interdependence guarantees safety. Comment if you want the next deep dive on which sectors face the highest structural risk, where capital is repositioning next, or how past transitions unfolded asset by asset. The goal isn't fear, it's foresight, and foresight only works before the crowd catches on.